So, first question, we have lost all our gains since the inception of the fund. How do you explain this? How do you protect the fund against future market downturns or a potential recession? And yes, it's true. We've had a significant drawdown in the fund in the last few weeks. And in general, this is true of not just a Wagons fund, but of any endeavor that one can embark on, is one can optimize for only one variable. Anytime you're trying to kind of pursue things, if you're going to try to optimize something, you can only optimize for one variable. You cannot really optimize for two variables. And for good or bad, the focus at the Wagons Fund has always been to try to optimize for long-term performance. So I've never given a lot of thought to volatility. I've never given a lot of thought to trying to smooth returns. I haven't tried to hedge things. Many of these things actually I would be useless at because I wouldn't even know how to do it well. So when I look at the portfolio and when I look at investments, the primary driver is this a bet with relatively low downside and relatively high upside with kind of a very favorable risk reward? It is in the nature of listed securities and equities which trade in auction-driven markets that they will tend to overshoot and undershoot from underlying intrinsic value quite significantly relative to other asset classes. So when we look at an asset class like, let's say, single-family homes or apartments or office towers and so on, it's an intelligent buyer facing an intelligent seller, and that tends to keep things within a relatively tight band most of the time. When we look at auction-driven markets, we can have much wider swings. And in fact, we just saw that overnight in Turkey, the mayor of Istanbul was arrested. He's the main likely number one contender running for the presidential elections in 2028. And it looks like a politically motivated action. And the markets didn't like that at all. I mean, they took massive nose down and the currency hit an all-time low and so on. And, our Turkish positions, all of them lost money last night. But then when I look at it from the lens of, what's the long-term intrinsic value impact of this action on these businesses, I really don't think it's much, if anything at all. And that's just the nature of how things are. I'll move on, try to make these answers brief so I can try to get to as many questions as I can. There's a question on our largest two bets, Edelweiss in India and TAV Airports in Turkey. Given that they are our two largest bets, can you detail the current undervaluation and growth prospects of TAV Airports and Edelweiss? I think I'd mentioned that currently Edelweiss makes up more than a fifth of the portfolio. And as of the end of the year, both TAV and Edelweiss were both about around 16% each. So they made up close to 31% of the portfolio at year end. These are highest conviction ideas, and we feel very good about both of them. So taking the larger one first, Edelweiss, we've been investors in Edelweiss in the other funds I run, Pabrai funds, and known the management and the company for at least 7 or 8 years. So we're very familiar with Edelweiss. I had recently spent a half day in Mumbai with the various business heads of their different businesses. So Edelweiss is a financial services holding company, and they have a number of different businesses. They had spun off their wealth management business a couple of years back, a very successful IPO. They are in the process of spinning off their alternative assets business. This is kind of like the Indian version of Brookfield Asset Management or BlackRock or Blackstone, etc. That company is likely to go public in maybe a few weeks or few months, and so they're in advanced stages. And Edelweiss basically is going to spin off a new company, one of their existing wholly owned subsidiaries, going public. There are about 4 of them that will go public in the next 4 or 5 years, cadence of about one a year. The market cap of Edelweiss is approximately 1 billion. Each of these businesses that are going to go public will probably come out at a market cap north of 1 billion each. So, I mean, from our point of view, the valuation makes no sense at all, because if I look at the alternative assets business, which will probably come public at a market cap of 1 to 1.5 billion, which is 100% currently owned by Edelweiss, its market cap when it's listed may exceed the market cap of the parent, which is kind of bizarre. But we had the same situation take place when they listed their previous business, which was the wealth management business. The wealth management business today has a market cap of north of 2.5 billion or so. And it also came public, approximately a billion plus market cap. And again, it was really not reflected. Plus, Edelweiss is still starting new businesses, and these businesses tend to require relatively low amounts of capital. They tend to grow fast. This is just squarely in the sweet spot of what is a very high growth area in India, which is, all the mutual funds and financial services and all of that. So we think that the position makes sense, and we think that we'll end up with maybe 4 or 5 different spin-offs coming out of Edelweiss in the next few years, all very nice businesses: insurance, mutual funds, alternative assets, and so on. And so we are happy to just be a shareholder for a long time. TAV Airports is probably the best management team I've met in Turkey. In fact, I would say it's one of the best management teams I've met anywhere in any industry. Extremely well run. They run a number of airports in Turkey. They also have a number of airports outside Turkey. One of their crown jewels is the Almaty Airport in Kazakhstan. And there are 2 Harvard Business School case studies on TAV Airports. In fact, if you go on the HBS publishing website, you can buy these 2 case studies for probably under $10 each. So the price is right. And one of those 2 Harvard case studies deals with the decision that TAV was facing on whether to go ahead with the Almaty deal or not, because the Almaty deal took place during COVID when passenger traffic was zero. And they had actually signed the deal to buy Almaty before COVID had struck. And so the company was facing a choice whether to declare force majeure and walk away from the deal, or whether to renegotiate and do the deal. And that's what that case study is all about, that Harvard did. And in the end, they made the decision to basically try to negotiate a better price and then do that deal. So that's basically what happened on their end. So the Almaty Airport economics are extremely favorable for TAV. I think there was about 120 million of equity that went in when the deal was done. The rest was 5% fixed interest rate for like 25 or 30 years, about like 300 million of debt. They've since spent about 250 million on a new terminal, which actually opened last year. TAV Airports may have EBITDA at just Almaty alone in the next few years, may be exceeding 200 million a year, growing at about maybe double digits, 10% plus a year. A business like that, if they were to ever put it on the market, would go for several $billion. They purchased the airport for like 300 odd million. So it was quite a deal. So I think that TAV has many great assets. They've got very strong growth in passenger traffic across all their different, many of their airports have a huge surge taking place with low-cost carriers. And it doesn't matter whether the carrier is low cost or full cost, etc. Basically, they are going to charge the same passenger fees. And so they've got plenty of tailwinds. I think that both Edelweiss and TAV are sitting at, small fraction of their underlying intrinsic value, and I think both will grow their intrinsic value. So I think that those are good bets from my point of view. I'll switch gears a little bit. I might come back to these things, but what I'm going to try to do is I'm going to try to take a question with a different subject or different industry, just so that I can give you more flavor. So there were a number of questions on our coal bets. And so one of the coal questions is, it appears to me that you're betting on coal prices over a shorter period than even 5 years, more like you're betting on prices going above 300 again inside of 2-3 years. Is that correct? The answer is that is not correct. I mean, all of our coal bets are metallurgical coal bets. They're focused on met coal, which is needed to make iron and steel. And there are brand new blast furnaces that are being commissioned today and that will be commissioned in the next 5 or 10 years. These blast furnaces have a 40 to 70-year life, and no one is going to build or commission a new blast furnace if they don't think they're going to use it for at least 4 or 5 decades. It is unlikely that there will be an alternative, scalable alternative, which is kind of reasonable price, etc., to the blast furnace method of making coal being quite significant several decades into the future, maybe even into 2070 or 2080. So coal bets we have reserves going out 20, 30, 40, 50, 60 years. And basically, we think that, as is not even, I think, just we look at the supply demand curves on where iron and steel production is likely to go and the associated met coal supply, we are likely to see a mismatch because of the lack of investment in the metallurgical coal space. Met coal is very different from thermal coal. It exists in very few geographies in the world. And generally speaking, even if there is a big find of something somewhere, the logistics and infrastructure required to tap and bring that coal to market can be quite challenging and can take a long time. So we think that these companies that we've invested in, which have like a kind of 1 to 2.5 billion type market cap, they have the possibilities of having single year cash flows exceeding $1 billion. So if I just take a 30 or 40 year view, there may be several of those years, might even be more than half or 2/3 of those years where cash flows might be north of 600-700 million. And so, if you have something that's trading at $2 billion and you're going to have on average in the next 20 years, 20-30 billion of cash flow coming out, that's a bet I'd like to make all day long. And so that's kind of where our interest in coal is coming from. There's another question on, can you please explain the decision of selling core natural resources and why have you sold CNR and decided to keep Warrior, Met and AMR? Well, core natural resources was a combination of Arch and Consol. And it's a mixed thermal and met producer. And we moved our portfolio to be a pure met portfolio because I just like the met coal side of things a little better. So that's kind of where we are. There's a question on Coca-Cola and Anadolu FS. Coca-Cola and Anadolu FS are out of our top 10. Have you lost conviction in these businesses? There was an event that took place, actually, I think right on December 31st, where Russia basically took over the assets that Anadolu FS and Am InBev had in Russia. They were the number one beer company in Russia. And this seems to be related to the whole Ukraine conflict and so on. It was surprising to see that because generally Turkey and Russia have had a decent relationship. I mean, it's gone kind of hot and cold different times. So that was kind of a little, it was surprising to see that. And events like that put things like Anadolu FS into the too hard pile. From our point of view, it just becomes difficult. One thing I should mention is the top 10 positions get reported for the Wagons Fund. Basically, the trust that the Wagons Fund is part of has some restrictions and limitations on our portfolio composition. So if you think about splitting the Wagons Fund into two halves, 50% of assets in each half, the first 50% has to have at least 3 stocks in it. No single one of those 3 stocks can be more than 25%. And the smallest of those 3, it's possible you could have a third stock at something like 5% or so. So the first half can be somewhat concentrated, but need to have at least 3 positions in there. The second half of the portfolio cannot have any single position exceed 5%. So if you think about the second half, and we normally target like 4% as a typical bet of the second half, you would end up with about 13 bets in the second half. And you would end up with, maybe if we went to the extreme end on the first half, you would end up with about 3 bets on the first half. And so basically the minimum number of stocks that the portfolio would have would be about 16 stocks. And so because of this relationship of the two halves and all of that, only about 7 of those 13 stocks in the second half may make it into the top 10. So if something is at 4% and something is at 3.9%, the 3.9% may or may not make it. So just something to keep in mind. There's a question on the US auto dealers. Do you regard successful expansion via acquisition as a critical component to the success of your thesis in the car dealership holdings? Any thoughts on Asbury's recent announcements regarding the acquisition of Herb Chambers? So there were 2 or 3 things where I think the market was misreading and miscategorizing the kind of the moats and the durability of the moats of these auto dealers. So the first expectation the market had was that EVs would dominate a lot faster than they actually are, and a lot of EVs would be sold direct to consumer bypassing the dealer network. And the third kind of thinking was that auto dealers make a lot of their money in the back of the shop with parts and service, and EVs are relatively low in terms of the usage of parts and service. So all 3 of these thinking, as we think, is off. We are already seeing that the desire of the American public to move to EVs is much slower than what people had originally forecast. People see a lot of issues with the range and range anxiety and charging times and a whole bunch of other issues. So the movement to EVs has been a lot slower. The second thing is that we also think that it'll end up that a lot of the EVs will go through traditional car dealerships in terms of sales, because for the OEMs, the selling going through the dealerships doesn't cost that much. The frictional cost of that is very low. So it just makes sense to send it through that. And the third is there's a lot of studies that have pointed out that from a total usage of parts and service of EVs versus non-EVs, they are quite comparable. And in fact, it might well be that EVs may be giving the dealerships higher margin overall in terms of parts and service, because the margins on like oil changes and things like that are pretty low, and a lot of that goes to third parties anyway. So basically, once a EV hits 4 or 5 years and their battery issues or changing the batteries and that sort of thing going on, those are big ticket items. Those typically have to happen at the dealership. And some of these players like Asbury and AutoNation, Group 1, we think they're extremely well run, very high quality management teams. I think they've been very prudent with their capital allocation in terms of buying other dealerships versus buying back their shares. And so I think it's a bet where we're paying relatively low multiples for very stable business for a long time. So that's kind of where we're at. Let me just continue on with the question on the home builders. And the US is structurally underbuilt, but it has been that way for quite some time, helping these home builders sell their homes for a higher price. But if quantity increases, won't the prices they charge be affected? So there's a lot of different variables that go into this whole notion of, what is the shortage of housing units in the United States. There's a lot of studies that show that we have several $1 billion of shortage in terms of homes, but the second issue that comes up is the affordability and, ability to buy those homes. So I think the bigger issue with the home builders is that the biggest ones have been taking market share from the mom and pops. And the bigger ones have a huge structural advantage over the small players. I made several field trips to the various home builders. We went into some of their model communities and so on with Toll Brothers and others. And basically, I think that it's difficult for a small home builder to be able to compete and have the same cost of production that the larger players have. The larger players also have brands which the buyers of homes prefer. And their capital allocation discipline, it took a long time for these guys to actually understand the NVR model. All of them are moving towards the NVR model, which is they're becoming asset light. So basically, all of them are moving in a direction where they're holding less and less land banks, using more options on land, and getting far more efficient. The other thing that they're doing, which NVR was a pioneer of, is they're setting up manufacturing facilities, kind of centralized manufacturing facilities. So large chunks of things are manufactured and then shipped to the site as opposed to everything being site built. So both of these things actually make it difficult for the smaller players to compete against. So I think that the home builders deliver great bang for the buck. They're being very disciplined in their capital allocation. Their valuations are low. They're showing good discipline on the buybacks. And so that's where we are with the home builders. The question on RESAs, what is the bull case for RESA's revenue and net income in 10, 15, and 20 years? How big could it get? One of the things about RESAs that we really like is the father and son team that run it. Both these individuals are very different from each other. In the words of the son, he says that my father is the accelerator and I'm the brakes. And in our observation over the last several years, I would say that is true. The father is a dreamer. He's far more creative. He's always looking at new businesses and new ventures that they can go into. The son is a very high energy, but also very good executor. But he has an aspect of him which is like an accountant as well. So he's very grounded in reality. And so what we've noticed is that there are healthy frictions and debates that take place between the father and son. At the end of those debates, we think that the decision that comes out is extremely good. So one of the things that has been important for us is that to make sure that both the father and son are in the picture. And they both are, their kind of relationship is the way it has been. I mean, there are tensions in that relationship, but I think those tensions in the end lead to very good decisions. The father is kind of mid-60s, and I'm not sure how long he will want to be engaged full-time in the business. Of course, from my point of view, it would be wonderful if he was engaged for several decades. So I don't think we can actually think about RESAs in time frames like 10, 15, or 20 years, because something may change in terms of the two of them and how involved especially the father is, or maybe even in 5 years or less. But as long as the duo is cranking, I think that I've never seen them make a mistake. In almost 6 years of observing them, we've never seen any decision come out, and they've made a lot of different decisions that we would consider dumb or misstep, which is surprising. I mean, the business could easily have a few missteps and still do well, but they've had a very good batting average. They've done really good deals and they're doing great. There's another question on RESAs. Is there a technical reason why we do not have a larger position in RESAs? And we could have a larger position. I think the body language we got from the founders is that it was very subtle, but they expressed preference that we didn't increase our stake. I mean, we got a very sizable stake, and when you include Pabrai funds and so on. And so I wanted to be respectful of that. Don't want to do things which are, causing animosity or something. We have a very good relationship with them. So we would have wanted to buy a lot earlier in the other funds besides Wagon Fund, but we've held back. And so, RESAs is not going to be a big position in the Wagons Fund. There's a question on Danos. You exited Danos in another fund but continue to hold it in this one. Can you walk us through the different risk-reward calculations behind these decisions? Were you not comfortable with the daily tanker rate outlook given tariffs and global economic situations? Danos is in the shipping business. We think it's quite undervalued. We think when you look at what they have locked in terms of long-term charters and cash flows coming out versus the market cap, it makes no sense actually. And we're happy to have the position in Danos. The Wagons Fund owns a lot more positions than I do, for example, in Pabrai funds, which doesn't have these position size limitations. So generally speaking, there may be several positions in the Wagons fund that don't have a slot in other portfolios I run. And I don't think there's much to be read in the reading the tea leaves on that. So I think that's just the way it is. The question on general fund philosophy, the Wagons fund holds a number of basket-like positions, coal companies, home builders, car dealerships, etc. If there's a preference, what drives the decision to hold multiple names instead of concentrating in the top-ranked ones? Is it a matter of liquidity, diversification, or another strategic consideration? And yeah, that's a good question. And I went through the kind of the buckets things fall into. We for example, have 3 bets in coal, and my preference would be to have a single bet because we think one of the 3 is the best of the 3. And if we could, we would put it into that one. Similarly with the home builders and similarly with the car dealers, in all of those cases, we have a set of kind of a basket approach because of the diversification rules. And I think with the car dealers, it's somewhat close, but we still think that there's a 1 or 2 that really edge out the rest. Similar with the home builders. I mean, my natural bent as an investor for several decades has been to be concentrated. Mutual funds cannot be as concentrated, and so we obviously are going to adhere to the rules, but we also want to focus on the ones where we have the highest conviction while being respectful of the rules. And so that's how we end up with the way we are. The question on what are your intentions to reduce the expense ratio of the Pabrai Wagons fund as the AUM grows? Is there potential that at some point it will be covered to a more tax-efficient ETF? So the Wagons fund, all mutual funds basically have a basic fixed cost. And as they scale, most of the fees may start dropping to the bottom line. We are not yet at the point where we have that scale. I think the Wagons fund would need to be several billion in size so that we are basically got sufficient scale. I'm not a big fan of fat fees, etc. So we've actually capped the fees and we've been subsidizing the fund internally as the assets are growing. And at some point, we can take a look at whether a reduced expense ratio might make sense. And there's a question on what have you read recently or are reading now that you would recommend. There's a book that came out recently called, I forget the exact title, I think it's Buffett and Munger Unscripted. But the guy basically went through all the, on buffett.cnbc.com, they've archived all the annual meetings over the last, I think, 30 or 31 years from 1994 onwards. And he went through and listened to all of them. And he recategorized all of them by subject, which is what Larry Cunningham had done to the shareholder letters. But I think the annual meetings at Berkshire Hathaway are interesting because Buffett and Munger really, the book is correct that it's unscripted. When they get a question, they don't know that question is coming. They haven't kind of, premeditated an answer, etc. And so we tend to get more of their unscripted thoughts in the annual meetings. I went back and listened to all those videos. They were 5 or 6 hours each. I've done it 3 times for the entire 30 years. So this book is interesting because it's rearranged it by subject, which is a very good take. So I think that's something great to look at. I'm going to go back and go through and see if there are more questions within these things, but I also see a number of questions in the chat window. So with Oxy, there's a question on Oxy, which is one of the portfolio positions. With current production levels and the oil price around $70, Oxy generates $4 billion in free cash flow a year. That's like a P ratio of 10 as for today's share price. That doesn't sound like an amazing opportunity, just a good one. Oxy's low carbon is great, but too far out with risk. So what am I missing with this story? I would say that Oxy is one of our lower conviction bets, but we like the bet. It's a bet on Vicky Golub, who's the amazing CEO at Oxy. And Oxy has a very strong footprint in the Permian, and they've done a lot of innovations in terms of how they're extracting and reducing costs and so on. And there are some moonshots built into Oxy. One of the moonshots is their carbon capture that they are into. Another of the moonshots, in Munger's words, is done a few magical things with fracking, which has led to all this growth, but they could find something more in terms of technological breakthrough or something. So they have the asset base. And when the oil price goes significantly below 70 or 60 or 50, a lot of the fracking production disappears. And to the extent that fracking is important in terms of the overall production of oil and gas globally, it tends to put a floor on the price of oil, kind of being the swing producer, if you will, at that stage. So I think we like the management, like the position, and I think they're very prudent in how they allocate capital and run the business. So that's kind of what is useful to us. There's a question on what are your thoughts on the future of homeowners insurance? Does this affect home builders? Well, I mean, people buy homes because it's a necessity, just like they buy automobiles because that's a necessity. And the insurance situation with single-family homes, a lot of that is dependent on geography, kind of where you are and so on. It is going to have an impact. I mean, in places like, I think, Louisiana, like Baton Rouge or New Orleans, it's like 1/4 of your mortgage payment is your insurance. And Florida is maybe like something like 17 to 20%. It's pretty high. But these home builders, their footprints are all over the place. So yeah, I mean, I think buyers would look at their total cost of ownership. And yeah, it's a negative, but I don't think it rises to the point where they may end up buying smaller homes or homes that are somewhat cheaper just to keep the affordability and so on. But I think they still need to have a place to stay. Another question on the U.S. auto dealers. We hold 3 car dealerships companies, but not the one I consider the best. Can you discuss why we invested in these 3? What makes them better than the others, especially PAG and its luxury skew and superior capital allocation? PAG is Penske. I actually agree with the person who asked the question. In all the time we spent with Penske, they were the most impressive. We visited their truck group in Dallas. I also visited their kind of trucking fleet operations in Pennsylvania, and we visited a number of their dealerships here in Austin, etc. So we've had a lot of discussions with them. It was very clear to me that Roger Penske and the organization that he's built is truly exceptional. I really enjoyed meeting the people and everything. There was a significant delta in valuation. So while it was the best, it wasn't clear to me that a Penske investment would do better, for example, than an Asbury investment. And I may be wrong at the end. I think that one of my flaws is I have difficulty paying up. And difficulty paying up has led to sometimes suboptimal decisions. And the Penske one was one I actually thought very long and hard about. When we visited there's a division of Penske called Premier Truck Group. It's outside Dallas. And this is a business where they basically retail and service trucks. And they've got a very strong lock with Freightliner in that business. It's a very symbiotic relationship with Freightliner. And when we went and saw their service base, you could eat off the floor. It was just, you would not normally think that a place which is servicing trucks is going to be that way. And then their lounge, showers, Netflix, lazy boys, work areas. I mean, what they had set up for the drivers. I mean, literally, if a driver is coming in, some emergency service, maybe takes few hours, that driver actually has a lot of facilities and resources in that area. And so it was just the way they ran that business, very different from anything else I'd seen. And I have a lot of respect for Roger Penske. And when I met their people, and Roger's I think he's in his 80s, but I think he's built a truly exceptional team and done a tremendous job. If I look at something like in Austin, Texas, for example, there are 2 Lexus dealerships in Austin. Both of them are owned by Penske. So basically, Penske has a lock. They have a pretty much a monopoly on Lexus, and Lexus as a brand does extremely well. I mean, we visited Park Place Lexus in Dallas, which is run by Asbury. That was one of the most mind-blowing field trips I've done to any dealership. I just couldn't imagine that someone actually had figured out how to run a dealership like that. It was just really unbelievable to see that. But in Austin, the way Penske runs it, so Lexus does not allow any single group to own more than 8 dealerships nationwide. They have tightest restrictions on ownership. And so all of these guys like Asbury and Group 1 and Penske are very thoughtful about which 8 dealerships they want to have. So for example, Asbury used to own the Lexus in Mission Viejo in Southern California. I actually had bought a car from them many years ago, and they divested that so they could get another one which they considered more prime. But for example, the Lexus dealership in Dallas, which is Park Place, which was one of the best acquisitions that Asbury has done, I calculated that they are selling a car every 30 or 35 minutes. And it's just a huge assembly line. I think their service bay for the Lexuses is more than 200 bays, and they're just going so fast. It's unbelievable. And the only dealer we found where the sales guy is fully empowered. So when he's making a deal, he doesn't go, like the Fargo movie and talks to his manager or any of that. They're fully empowered. They finished a deal, they get it all done, and they get it done fast. And they basically are kind of Sam Walton's philosophy: stack it high, let it fly, make a reasonable profit, but keep the volumes going. So yeah, our forays into, when I was looking into the car dealerships, it was really impressive to see Penske. And it's funny, they were telling me that like the guy who runs their fleet trucking business in Pennsylvania will say that he'll get a call from Roger, and Roger will be driving somewhere and he'll see some truck, and the truck is dirty. So he'll call the CEO of the business saying, hey, this is the license plate number, blah, blah, blah. This truck is dirty and it's messing with my brand, etc. And so he's constantly getting calls like that from Roger. And another thing is that Penske fleet, if you notice, some of the trucks are yellow and some are white. Roger Penske wants all his trucks to be yellow. He loves the yellow color and all of that. But the issue that the general manager of that truck fleet business has is that he says, when I sell a yellow truck, I get $3,000 less for it. So he said, I'm not going to have all yellow trucks. I mean, it's going to affect my numbers. So he said, I constantly have debates with Roger where I'm telling Roger, I'll give you some yellow trucks. I can't give you all yellow trucks. I think Penske runs a great shop, but so does Asbury. I mean, I think Asbury Group 1 are really good, but I would still rate Penske higher. But you're paying a premium, and then the question is, where do you get the biggest risk reward? Why does Wagon X not have a single investment in technology or healthcare sectors? Well, a lot of that stuff may be outside my core competency in both cases, or I may not be, for good or bad, be willing to pay up. So anyway, I think we're at the top of the hour. I want to be respectful of all of your time. We'll try to do these calls more frequently, at least in the near term. But I think that the Wagon X portfolio trades at a single digit multiple, and the S&P is north of 25, etc. And I think February 18th to 19th was a all-time high peak for the S&P. I don't have any crystal ball, but it might not hit that number for some time. So we like where we are sitting and where we are positioned. And thank you for your support. And